Bernstein already and Pranav is here. Just keep in mind, I mean, a lot of these stocks will correct. RKN, Sheela Foam or a nuclear software, just a very wobbly set of numbers. And therefore, all of those could correct. But let's get in. Pranav Gundlapalle, Senior Research Analyst at Bernstein, into the conversation, as Tamanna was saying, because SBI numbers are out. A lot of other banking results are out too. Pranav, great having you. Thanks for joining in. Your initial thoughts on Bernstein? Vishy was saying that it's not that it's not half bad. It's actually closer to good relative to what some of the other banks have done.
Yeah, I think it was this quarter's numbers per se were decent. I think the ROA staying about 1% was a relief. But I think if you look at the underlying trends, then I think one does become a bit more cautious about the ROA trends ahead. Because if you look at the deposit growth, 8% was probably the lowest amongst the larger banks. The NIM fall of 8 bips, again, higher despite the weaker deposit growth. So some of these trends tell you that 1% ROA would be tough to maintain in the quarters ahead. So yes, a decent quarter, but the trajectory ahead doesn't look too great.
Right, Pranav, a quick question from you, Vishwanath. In terms of the deposit growth, now you said 8% odd is lower than before, but considering the current market scenario, considering the way liabilities are sort of reacting across the banking space, 8% doesn't look that bad.
See, I think the one to watch out is a 15% loan growth versus the 8% deposit growth. So this quarter, yes, they could pull it off because they dipped into the investments. They did use some of the excess SLR. But the LCR now for a lot of the public sector banks is almost in line with the private sector banks. So SBI's 129, 128, 129 is not too far away from an HDFC or ICICI's 120% plus. So which means that going forward, we will see a convergence of loan and deposit growth for these banks. And if the deposit growth doesn't improve by a lot, you know that the loan growth differential will start to look quite jarring.
Right.
So that's the real concern.
Right. SBI specifically has been a long-term sort of victim of this first quarter turn in asset quality, especially on the agri portfolio, because they have a sizable portfolio on the agri side. This quarter, that didn't seem to pop out too much. Things look fairly stable on SBI's balance sheet.
Yes, so that was the other good part this quarter, where when you had some amount of asset quality issues, even for the private sector banks, select private sector banks, none of that seemed to show. And especially the express credit, which the bank did clarify, continues to remain a higher ticket size product with average tickets of about 7 lakhs or so, did seem to be immune to the sort of stress we saw in the case of Bajaj Finance or in the case of SBI cards, etc. So I think that was a bit of a relief. And I think the seasonality was mixed across banks. Some banks quoted the election heat wave, others had the agri issues to quote, but that was thankfully a lot lower in the case of SBI.
I just found that interesting how you said that different banks had different reasons to quote for seasonality, and I just found that an interesting take. In SBI's case, you also say that keeping ROA at 1% will be difficult for them or might not sustain. Can you elaborate on that?
Right. So if you look at the various levers that were pulled, you had a higher LDR, you had weaker deposit growth that does improve the margins. Plus you had OPEX, which literally was flat year on year. So some of these are difficult to extrapolate into future quarters. So once you start normalizing these factors, then that 1% ROA does seem to be a bit of a challenge, especially with credit costs still being lower than some of their private sector peers. If that even reaches what you have seen for some of their private sector peers, then yes, that 1% does look a bit challenging.
Pranav, quick question around the broader, sort of banking space. This quarter, some disappointments. You saw your deposit growth sort of shrink more or less across banks, even on a sequential basis, if you were to look at it. Asset quality situation not looking too bad, but also not exactly great numbers. To your mind, what is the one takeaway that you would take from the banking space results Q1?
So I would say we're just seeing an accelerated normalization. So that's what I would say. So I'm not seeing any big reasons for concern. And deposits is not a concern for us because if you go back to 2010 to 17, almost about 65% of an annual deposit accretion happened in the last quarter. So we are probably going back to that level of seasonality. So 1Q being bad sequentially shouldn't be a big concern. Year-on-year growth number is still the highest in a decade at 13%. So a bit of a dip here and there should not really matter for us.
So, Tamanna, you want to take a question with Pranav?
Yeah, just a couple of things, Pranav. One, the call today for SBI, all things considered. I wanted to start with that, and then a view on what you've said on SBI cards. But let's start with the SBI, call for the day.
SBI, we think it's a hold. We don't see room for re-rating. So yes, that a decent ROE should mean that compounding continues for a while, but no room for re-rating. So we'll just keep a hold on that. On SBI cards, we have a sell. We think the asset quality troubles would last a lot longer. Clearly, there is trouble in the smaller ticket size segments, and we have a sell on SBI cards. So we see a lot of asset quality issues even for a few more quarters.
I still remember the line that you mentioned in your report on SBI cards, which says "sell as soon as you can." Just a last word. Most broader credit card lenders don't seem to have been showing the trend that SBI card specifically showing. Anything that's sort of different there?
I think it's just the ticket size and the smaller ticket, let's just call it mass market segment, which has seen the biggest activity from fintechs and all the new lenders who jumped in, seems to be the one that is seeing the asset quality stress. Lenders exposed more to those segments are the ones who are seeing trouble. So it does seem to be localized to that segment, but it is broad-based within that segment. So it's not one particular lender. Everybody's going to be affected who are in that segment.
Pranav, sorry, I'll make this the last question. Excuse me for that. I know we were decided, this is Neeraj here, and we were thinking of talking about only SBI, but I want to check with you. The global markets are in a bit of a tizzy. Do you reckon that Indian banks, by virtue of the fact that the private bankers are not quite trading at the valuations that they erstwhile used to, could withstand the kind of pressure that comes in on world markets by and large? Or do you reckon, I'm just trying to understand, are valuations attractive enough for you to advise your clients to go in to buy Indian banks if they were to correct another 5-10%, or that is not necessarily the case?
We would advise to go into the banks, provided the horizon is a bit longer. The banks are cheap, but this whole ROA normalization will play out over the next few quarters, which means there aren't going to be any nice upside catalyst driving a re-rating. So it's going to be like, yes, valuations are cheap, so which means downside is going to be limited, but you'll have to wait for the entire re-rating to play out.
Okay. Pranav, so good talking to you today. Thanks for taking the time out. Thanks for accommodating the time change request as well. Really appreciate it.
Thank you.
All right, that's the view from Bernstein on a bunch of results. Vishy, thanks for joining in for this whole conversation as well. And let's take a break on the note. By the way, the implied open should come up on your screen. It's not looking all that pretty. Remember though, the Indian markets may be a bit more well behaved than the rest of the Asian markets, which is a sea of red with anywhere between 2.5%, 3%.
It's all relative.
This is
also going to be a sea of red.
Yeah.
But just two lines from what, and we'll put that out for you, what Chris Wood is saying in his Greed and Fear, and there's a lot of detail. But look at what he says. 2 lines on what he says on the Indian markets is where he says the Indian stock market is much more resilient in the face of a US downturn because India's stock market has been driven by domestic money, whereas the opposite is in Japan. So all you people who've been keeping up your SIPs, retail investors, this is the time that the Indian markets are going to bank on you. Very quick break. We're coming back with the FNO setup with Agam Vakil. Stay tuned.